Welcome back to the third episode of Dividend Discussion here on Dividend Obsession. With this new series, one of my goals is to share my passion for passive income through dividend investing with others. During these interviews, you're going to hear the story of someone else that's doing dividends their own way. Hopefully, you, the viewer, can take something out of each and every one of these interviews to make yourself a better dividend investor. For my third guest, please join me in welcoming Michael. He's another one of my friends through the Dividend Growth Investing Facebook group. He's new to dividend investing and he's figuring things out as he goes. In this episode, we discuss the importance of paying off debt, why dividend yield is so appealing, different portfolio ideas, and much more. But without further delay, please enjoy the show. And welcome back to another episode of Dividend Discussion. I'm here with my friend Michael. Michael, if you want to go ahead and give yourself a brief introduction.
Sure. I mean, there's not really a whole lot terribly interesting to say, I guess, but my name is Michael Gmirkin. I live in Portland, Oregon area. I work as a data manager for a small nonprofit. We serve adults with developmental disabilities. Kind of some interests in math and various other stuff. Went to the University of Oregon, studied computer information technology. Do a lot of work in Mathematica and Excel, that sort of thing, just kind of fun hobby stuff. And recently, I'm kind of at a point in my career and or life journey where I feel like I have enough income that I can actually start kind of looking kind of more at the future and what I can do to kind of secure my place in it financially, I guess. Getting out of debt. Just recently bought a condo, which was kind of cool. Got enough income for that. And then looking at, getting into investing for the future. So whether that's kind of growth stocks, dividend stocks, that sort of thing.
Yep.
Initially just kind of started out with just the company 401k, which I didn't really know a whole lot about. Apparently you can only select from like a small list of like whatever mutual funds or something like that. And there's like 20 or 30 funds, and you just have to kind of pick a couple of them and how you want to weight it. And at that point I really didn't know a whole lot about investing. So I was just kind of like, well, here's one that's supposedly high growth, one that's kind of like mid-cap stocks, maybe a combination of both of those, something like that. But didn't really know much more than that. But being me the way that I am, I like to kind of dig into things a little bit. So I started watching some YouTube videos on investing generally, and then kind of got directed more towards dividends and kind of like passive income streams, that sort of thing. Around kind of the same time, kind of found out about like Roth IRAs and kind of some of the tax shelter benefits and that sort of thing. So like kind of down the road, you can basically keep your money as opposed to having to pay a ton of it to the government when you sell your stocks and that sort of thing. Again, still didn't know a whole lot about investing, but also around the same time, got into the dividend growth investing group on Facebook, which you and Chad and a few 1,000 other people are part of. And so started reading a whole bunch of posts there, and again still just watching a bunch of different YouTube channels on dividend investing. There's like Average Joe Investor, Let's Talk Money with Joseph Hogue, or some of the other ones, Gen X Dividend Investor, Bob Sharp. Once you watch one or two of them, it starts suggesting all of them in your YouTube feed.
Yep.
So I got a couple of good ones that I kind of subscribe to and watch a bunch of their stuff. Just kind of started getting interested in kind of the whole dividend and dividend growth investing thing. And one of the things that I kind of started doing while doing that was I'd look through kind of all the comments on the YouTube videos, and everyone would have kind of their own favorite particular stock or ticker or ETF or that sort of thing. So I just kind of go through the comments just looking for particular tickers, and then I go over to Seeking Alpha and kind of look at some of the charts on like what their price returns were, what their dividends were doing, that sort of thing, and then just kind of putting them into just kind of some Seeking Alpha watch lists, just so I could kind of look at their performance over time and just kind of go back and just remember what some of the tickers were, because there were hundreds or thousands of them that people were like, well, this one or that one, or whatever. And then at some point, I started trying to get a little bit more, I guess you could say, systematic about it, sort of. So I started kind of dividing up the watch list into kind of different, just say like kind of topical watch lists. So a couple of them were kind of based on uh, like dividend growth performance, which ones seem to be growing faster, stock price performance, that sort of thing. Then I started kind of comparing some of them in like the backtest calculator or charting on Seeking Alpha, just kind of comparing them versus each other to see what their total performance was and what their performance was versus some of like the market indexes. So like your IWM, SPY, IWF, QQQ, kind of some of those broad market ETFs, which are kind of the standard for kind of, I guess, back testing against to see, well, can you achieve gains similar to the like overall market? Because a lot of people are just like, well, just put everything in the S&P 500 ETF, and you're pretty much going to get rich if you keep just consistently investing into it.
Yeah.
So kind of my one of my thoughts anyway was when looking at a stock, how does it do versus those market indexes, and which index should you use? Should you use SPY, or is there a better one to kind of look at? And so I actually kind of just charted the indexes versus each other just to kind of see how they kind of compared relative to one another. And so kind of over the long term, I was just kind of seeing, does one of them consistently perform better than the others, or do they kind of trade blows over time, that sort of thing. And so, I mean, if I share my screen here, so I can do this really quick. So if we're just looking like Seeking Alpha charting, you can see just kind of the four indexes that I was talking about. So you have IWM, you have SPY, which is the S&P 500. I think IWM is based on, what is it, the Russell 2000, I think. IWF, which is kind of a growth version of IWM, which performs a little better, and then there's QQQ. And so kind of over time, you can see that kind of long term, like over like in this example for the last 5 years, QQQ has returned about 106% portfolio return versus the bottom, which is IWM, it's only produced about 17% return. And so it's just kind of looking at them, kind of comparing each other, you can see they kind of almost go into like kind of tiers where kind of IWF's at the very bottom, only gets about 17% return over the last 5 years. SPY, you get about a 70% return. IWF, which is the growth ETF, gets about 80%, 90% return. And then QQQ, you pretty much doubled your money over the last 5 years. So when we're kind of looking at investing, I guess kind of one of my ideas is that, or some people would say that kind of total return is one of the kind of big goals per se. So that when you're going into retirement, and basically you want as much money as you can have at the end of the day.
Yeah.
So that sounds fairly reasonable. So kind of one of my thoughts is if we compare different stocks to the top ETF using like QQQ as kind of the called the baseline or the thing to kind of test against, then you can compare other stocks to that and say, well, does it match the performance of QQQ consistently over time? Does it exceed QQQ over time? So if we're like kind of trying to get the best return on our money, that's kind of one of the ideas that I have, is just kind of look at different things, just kind of see their performance versus the different indexes. So that's kind of where I am kind of at as kind of like a starting point, and I have kind of a few other ideas.
Yeah. So, I mean, a couple of things on there. I mean, you mentioned that were getting your life together. You were getting a condo, and then you finally got started. The common sayings that best time to get started was yesterday, and the second best time's today. So it's good that you got started
20 years ago, and then
yeah, exactly. Yeah, like it's always the sooner the better. But you do what you can. You can't go back in time and do anything. I mean, most investors I speak to, that's the common thing that they talk about is
Yeah.
I wish I would have started sooner. Like I started in 2020. So I was 26, I believe. 20,
Mhm.
yeah, 26. So I wish I would have started at 18 or 16
Yeah.
or
Yeah.
whatever it was, but
Yeah.
there's
Yeah.
nothing
I
you can
pretty
do
much
about that.
started last year.
Yeah.
Pretty much
Yeah.
roughly the
So I
start of the
mean,
year.
the cool thing with your story is I have, so I've been, like I said, at it since 2020. We're basically coming up on 3 years since I've been investing. I've went through literally picking stocks from the best performers list on Robinhood. That was my whole stock
Mhm.
criteria, to backwards engineering dividend yield, to figuring out my own criteria. So I do have a video on the channel. I'm not sure what you have and haven't seen on the channel, but there's a video on there that talks about like selecting your stock criteria, and it can be as simple or as complicated as you wish. And at the end of the day, like, not saying that, using this metric or that metric for evaluation is right or wrong. It's just whatever
Right.
you understand, whatever you can explain, whatever you can use to help you get the best returns that you can get. So the reason I brought that up is you're comparing to broad market indexes, which is kind of similar to what I do. So I just use SPY. And there's another great resource that I use that's free. I like Seeking Alpha, but you are capped at 5 years for free. If you've ever
Right.
used dividendchannel.com, that one is so if you watch my Power 5, the videos I release every Friday, the last two that I released, so the one I just released yesterday at the time of recording, and the one I just released the week before, I started putting the screenshots from Dividend Channel on there. So what that does is you can go back. I think the earliest it goes is August of 1995, August 1st of 1995, and it's all free. And it does total returns. It shows you two charts. It'll show you the one with dividends reinvested, aka your total returns, and the one without dividends reinvested, aka just stock price appreciation. And it tells you what it's done over that, and it's with a lump sum $10,000. So it'll tell you what it turned into, the yearly compound, the total growth, all kinds of stuff.
Right.
So that's a very, very good resource. And what you can do is you can change. So say you want to compare Coca-Cola to the S&P 500. You can change what you're comparing each stock to, and you can even, it gives you, I think, the 4 major indexes, and then you can even select it to where it will let you pick a certain stock or another ticker that isn't one of the 3 major indexes. So for instance, if you wanted to randomly compare Coke to Pepsi over the last 25 years, you could do that. And you could find out which one's better with total returns or just capital appreciation or anything over the last 25 years. Or if you wanted to narrow it down to a year or 6 months or whatever, you can change all those dates, which is super, super cool. So that's another resource you can use. And all that to say, my simple criteria, I mean, spoiler alert for the video, is I like stocks that have a dividend streak of at least 5 years, because that shows that they're consistently able to pay and grow their dividend, which is important to me. I like stocks that have so dividend streak of 5 years. I like a dividend growth rate of 10% or more, just because I'm at the age where dividend growth rates are gonna, be really cool for me. It's also nice to get a 10% raise for not doing anything, which is super cool. And then the last one is outperforming the S&P 500.
Mhm.
And those are my three. Now, the one simple metric I've kind of added since then, I've only bought one stock since then. One a new stock, is I like my payout ratio to be like under 40%, under 30%, just because if they're going to keep increasing that dividend growth rate, or keeping the dividend growth rate, or keep increasing that dividend the way I like it, they need to have room to do so. Like if they have
Mhm.
a 60-70% payout ratio, there's not much room for that.
Right.
So yeah, all that story resonates with me too, because I was in your same boat. I think you're actually getting it a little bit quicker than I am, which is really cool. As far as like understanding, like, oh, okay, like this connects to this, but like what happens if I do this or whatever. So
Right.
those are all really cool things to hear. So let me jump into the first question. So what got you into dividend investing? And I mean, you kind of already spoke on this, but like, when did you get started? So like, what exact year, month, if you can have that, or like, what caused you to get into dividends in general?
Right. Yeah. So like I kind of mentioned previously, I was just kind of at the point in my kind of job cycle. Um, I've been at my current job for going on, I think, 19 years in June, 20 years next year. Kind of amazing to have a job that long these days. Everyone tends to kind of jump around a bit. But recently got some fairly sizable raises and then cost of living adjustments. kind of several years in a row. And kind of got to a point where I felt like I was making enough income that I could get debts paid off, basically buy a house, and then kind of start looking at, investing. So again, I just kind of started with the, company 401k, but then I, found out that you can only invest in like a couple of specific funds, and that kind of didn't quite match up with what I wanted to do as far as investing, since I kind of learned about like Roth IRAs and that sort of thing. So I've kind of transitioned then over to that. So I think the 401k, I think I started like 2 years ago. And then the Roth IRA I just started, like started last year. And so I kind of got the previous year's contribution kind of maxed out before the tax deadline and started in on last year's, which I just maxed out in January this year. I had to dump like an extra 750 or something like that to max it out for the year.
So do you have goals of like retiring early? I don't even know what retiring early really means. Let's just say 65 is average retirement age. Do you have plans of retiring earlier than that?
I mean, at this point, I've kind of just started, so I don't know, just because I'm not quite at that point, I guess, kind of in the investing journey. If, I mean, maybe, I guess,
Yeah.
if I get, good returns or, you know, good kind of annualized dividend payments
Yeah.
that's sufficient to live off of, then maybe, or maybe I'll keep working and just, investing more money and kind of growing the snowball or avalanche or whatever.
Yeah.
You know,
Well,
hold
it
off.
really, yeah. The reason, so another shameless plug. The reason I was asking that is because so I released a video, I don't know, probably a month ago, that talks about like choosing your path towards retirement. My goal is to retire at 50. I'm 28, so I have 22 years left. And based on what you want to do, like if you really enjoy your job and retiring early is like, I don't really need to. Like it'd be nice if I could, but like it's not a thing I need to do. Then you could go the path of regular, whatever, like I said, whatever average age retirement is, you could go that path. And that would be, like basically you've already done a really good job of, by the sounds of it, of like getting out of debt, reducing your expenses, increasing your income. You've already accomplished all those steps. So like next would be like you have your 401k and company match. That's free money. You got to get that. And then you go to your, if you have an HSA, I don't know how, it depends. HSAs are right or wrong for some people, depending on how often they go to the doctors or whatever. But you have your HSAs and your Roth IRAs, which you did a really good job of getting one. And because I had to do the same thing, I found out about a Roth IRA. I was like, oh crap, I got to get this thing funded. So you did a good job with your catch up on that, and then you got the previous year done, and then you can work on funding 23, and then you can just stay ahead of it. And then where the road splits is if you plan on retiring early, your next avenue would be to open your taxable account, which is where I do not all of mine, but that's where I put the majority of my money afterwards. Because that's the money I'm going to need to live off before 50 or before 59 and a
Not quite
half.
there yet, but
Yeah, exactly. So, I mean, if you're at the point where pretend you want to work till 65. Yeah, pretend you want to work till 65. Your path, the smarter thing to do would probably be to, and again, this depends on what kind of funds your 401k even offers. Because I know I've been with some companies where they've offered like really horrible funds, like it's mostly target date funds, and like here's one or two funds or whatever. And then I've been
we have
with
a few of those, and then we have a few that are kind of more
yeah,
broad.
again, not professional advice by any stretch, but target date funds I think are trash. They're like typically the expense ratios on them are high, and it's just like you leave. It's not that they're bad. It's just the opportunity cost of investing in basically everything else would be better. So, I've just looked into those, and a lot of times the 401k is one thing I don't appreciate is like the expense ratios are relatively high, and there's also like I was getting like quarterly fees on one of mine. We're like, oh yeah, here's your dividend, but we're gonna take $7.95 of that to pay this monthly fee. I'm like, I don't have any options. Like, how's that fair? So, but yeah, so I mean that's the thing. So if you do plan on retiring at quote unquote regular age, maxing out your 401k might actually be a really good strategy because that all comes off your taxable income. So then you're just paying a lot less in taxes and you're still able to invest that money. And then, once 59 and a half hits, you have access to that money anywho. So, that's not that bad. But anyway.
Yeah, right now, yeah, mostly focusing on the Roth IRA and kind of getting that maxed each year. And then as I get additional COLAs and raises, going to try and max out the 401k and get remaining debts paid off, and then kind of once those are maxed out, then you probably start it on taxable account.
Yeah. Yeah. I mean, everybody always wants to talk about the dividend snowball, but that debt snowball or debt avalanche, that's real too. Cause like most people, your biggest monthly bill is going to be your house or your, whether it's a rent or a mortgage, then you go into your car. But then sometimes people's, debt payments are actually bigger than their car payments, where it's just like, hey, I'm paying $400, $500, $600 a month in minimum payments. And I'm like, man, if you can just like, it's one thing to increase your income, but the biggest thing, the thing that you can actually control is reducing your expenses. And
Yep.
then that just does so much, because then you talk about your emergency fund, like you need less to cover because you don't have as much that you're spending each month. You're able to put more back for investing. Like you don't need as much to retire off of, because like instead of spending $2,000 a month, you're spending $1,500 a month. So like all the goalposts get a little bit closer just by doing that one thing, which is really, really, really big for people. So, okay. So next question. So, I mean, we already went over like what kind of investor you were when you first got started. So let's just jump into like what keeps you going, like what keeps you motivated to do dividends. Is it like the social media? Is it YouTube? Is it the numbers that you're running that are, showing you that, hey, this thing could actually work, or what is it?
Right. All right. Well, let's actually skip back to the previous question for a second. So when I initially started with the Roth IRA, really didn't know a whole lot, and so kind of one of the first things that I did that probably pretty much everyone does was chase a bit of yield.
Mm.
Trying to get the kind of like monthly income sort of thing going on, which for a while I did, and was actually pretty good income. But then as I started looking at the actual how much was invested into each particular ticker, and then seeing what that number was doing over time, starting to lose money on some of those kind of more income focused, stocks or tickers, but that were having, basically capital erosion over time.
Yep.
Just because the yields were, unsustainable, that sort of thing. So a couple of those, USOI, I forget what the other ones were offhand, ended up kind of exiting some of those, positions just because they were losing me capital, and I didn't feel like I was getting enough, kind of out the other side.
Well, you were aware enough to think of that though, because a lot of times that's what happens with those. It's a common thing that dividend investors, when they get started, that's what they're attracted to. They're like, okay, my goal is to make money off of these investments passively. These funds will get me that the quickest. Let me invest in those. But it's the like the investing sleight of hand, the magic trick, where they'll give you $75 in your left hand and then take $100 from your right hand. So here's your 75 in dividends, and here's your loss of $100 in capital appreciation. And then like, don't look at the other hand, like just worry about the $75. So that happens to everybody.
So when I had originally started, I had some fairly complicated like Excel spreadsheets that were showing with this particular return, whether it's 5%, 10%, 20, 30, 40%, if you get those kinds of yields, how quickly would your essentially like monthly dividend income go up or whatnot.
And you said you've been doing this for the last 2 years?
For the Roth IRA, about the last year.
Yeah. So I mean, like I said, you're doing, you being the type of person you are to ask questions, because I'm a why person too. Like I'm never here's the answer. I'm just like, okay, cool, that may or may not be the answer, but why is that the answer? So digging into that really helps with the fact that you fell into the trap of dividend yield like everybody else does, or everybody else seems to do, but you were able to get out of it so quick, saved you a lot of time, a lot of loss, and all kinds of stuff. So
yeah, because when you look at the actual numbers, if you're like 5% yield, I was just kind of looking at how quickly do you get to $100 a month. 5% yield is maybe 2 years. If you go up to 15% yield, click over here, then potentially you could get up to $100 a month in just 9 months.
mm-hmm.
If you go up to 20% yield, goes up to or down to 7 months. If you're like 40% yield, it goes up pretty quickly. Within 3 years, you can get $1,000 a month in income. That's assuming that the stock price stays the same, the dividend itself stays the same, and the yield stays the same.
Yeah, and they're able to pay that 40% yield for 3 years. Yep.
Right. But the thing that you end up coming across is that those higher yields tend to be unsustainable most of the time. I mean, there's a few kind of corner case exceptions, like ABR, where you can get like a 10%, 11% yield, and the dividend itself seems to continue to grow over time. So there's but that one's not at the like 20%, 40% yield sort
Yeah.
of thing,
I
which is
that was
always,
actually in one of my most recent, not most recent, but one of my pretty recent, like maybe 2 or 3 Fridays ago. That was the highest dividend yield, and that was, most of the time on those Power 5, I don't want to do a lot of not research, filtering. Like I want to kind of let the numbers speak for themselves. So the only thing I do is I make sure that it pays for 5 years or more and pays and grows, and it also beats the market. Then everything else is fair game. If you're the highest yielder, you're the highest yielder, whatever. But typically, when you start adding that beats the market, like outperforms the S&P 500, I see all the higher yields. They just fall off because it is, that here's a dollar today in lieu of a dollar tomorrow. Like, or I guess a dollar today in lieu of $10 next year. Like, that's
mm,
more or less what it is. And ABR, actually, I was very surprised. It was like a 13% yield. I was like, wow, that's a really high yield. It outperformed the market, grew its dividend for more than 5 years in a row. I was like, hey, I mean, that those videos aren't intended to be like, hey, here's 5 stocks you got to buy. It's just like, hey, if you're
yeah,
into any of these kind of categories, here might be one that you can research over the weekend. And if you like it, you buy it like Monday of the following week, which obviously we have Memorial Day coming up. But you buy it Monday the following week, and it goes ex dividend the following week. So that means you'll get in before the ex dividend. You can get that next dividend too. So that's just a little cherry on top. But yeah, ABR seems to be, I mean, from the very little research I've done on it, that one seems to be one of the higher yields that actually seems to be of somewhat quality. So
yeah, that one's on a few of my watch lists for
yeah,
various reasons.
yeah,
But yeah, it's the 10-year performance on it's just been
yeah.
phenomenal.
When you have, so like, yeah, it's using your criteria, and like I said, nobody's criteria is right or wrong. It's whatever they understand and stuff like that. And then it's also understanding your timeline when you need the money. There was a post this morning on the group that I think it was this morning or last night, where a guy, took a screenshot of his portfolio and he was just like, how do I make more money in dividends? And, everybody was just like, invest more money, whatever. And I, put one word answer and then followed it with a little bit of an explanation or more of a question. And I said, first thing you got to do is like, you need time. Like time is what makes your dividends grow. Obviously capital, but time also. And then also like, I ask him the question of like, when do you need the money? Cause so often people, especially that are new in the space, they judge how successful or smart somebody is in the dividend world by what they make in dividends, not realizing that like for my stocks, when they go down, I have plenty of time. If they go down, to me, that's a buying opportunity. I don't need the money for years and years and years. So I don't care if my stock price goes down today because I don't care what it's valued at today. For me, Microsoft goes down 20%. Great. I'm buying 20% more with the same amount of money. Perfect for me. But it's also the yield. Like I try to get my yield to grow exponentially year over year over year, but not my yield, more or less my income from my stocks to grow exponentially year over year. But like I also don't necessarily care what I'm making in year 1 of 22 or year 5 or year 10 of 22. I just need, by the time I get to year 22, I need that money to be able to supplement my income or really be my income for my early retirement. So like that's really important for you too. So if you get that criteria down where you're like, hey, I want my stocks to meet these 1, 2, 3, 4, 5, whatever, how many or however many are on your checklist, meet those things, and then also understand I don't need this money today. I'm not smart or stupid because of how much money I make today. It doesn't matter what I make today. My goal is to get a foundation that I can build my dividends off of for years to come, decades to come.
Mm,
So that's all really cool. Like I said, it's super cool seeing that you're into all this stuff because it's a lot of the stuff that I also was thinking about with the spreadsheets and calculations. Like I said, I actually backwards calculated dividend yield at one point where I didn't know what dividend yield was. I didn't know payout ratio. I didn't know none of this stuff. And I was sitting there with a spreadsheet and I was like, okay, if I were to put $100 into these stocks, I think I actually went on like dividend blue chips is what I found, like it was tons of stocks. And I was like, if I put $100 into this stock, which one's going to give me the most money? And I was like, ooh, this one's giving me 7 cents per $100. And I literally I didn't buy the portfolio, but I made a portfolio, like a mock portfolio out of like the top 20 stocks that would give me the most bang for my buck. I think I called it the bang for your buck portfolio. That was literally figuring out what their dividend yield was. Like I don't know why I didn't put those two things together, but I thought I was, doing some things and I did that. So, um, okay. So yeah. And then, yeah. So what keeps you going? Like that was the question for you.
right. Yeah. So I mean, kind of, I think like yourself, I do like kind of looking at. I mean, I guess kind of seeing the income that I'm getting and that it's slowly, building over time. Um, I mean, I guess that's kind of motivating to see that, month over month, the amount that's coming in is reasonably consistently going up, with the additional contributions and buying into different positions.
So do you have I'm assuming you have a spreadsheet to track like your positions and your, the growth rate and how much you made in dividends and stuff like that?
Uh, Not that specifically. For that, I've mostly just been looking at the website. Basically, I use Chase for the Roth IRA,
Okay.
and so I've just kind of been looking at just kind of their metrics or whatever. How much was invested, what it's currently worth, that sort of thing.
Yeah.
Just kind of seeing how much it's projecting for the years worth of dividends based on what's currently invested.
So, I mean, I can send it to you after we're done with this meeting. I have a spreadsheet that I made. I want to redo it. It does plenty of what I needed to do. I just want to make it look prettier for my videos. But it has a chart for each of my account types. So I have it broken down by account type, what the holdings are, and then how much I receive in dividends. And then I also have it broken down, like it all accumulates on one tab as well. And the thing that will really help you and anybody else that's watching is actually tracking. In March of 23, you made this. So let's do January, February, March. You made this in January, this in February, this in March. Then it totals it up by quarter. And then what you do is you go all the way down. It'll tell you what you made each, because you're not necessarily going to get growth from January to April. Like it doesn't always happen like that, just because like certain stocks, like they bleed over a month or whatever. They pay a little early or whatever. So you don't necessarily want to compare growth like that. But it is cool to compare Januaries to Januaries. And I have that on my chart where it quite literally always directly compares to the month of the previous year. So I can look at it and be like, okay, now it's May. In May of 2022, I made this much. Now I'm up to this much. And it'll tell you your year over year growth rate. And when you first start, I've said this thousands of times, when you first start in dividend investing, the big thing is to focus on the biggest number, which when you first start is going to be your percentage growth. It's not going to be the amount. You're only going to get, $3 from this company, $10 from that company. But when you focus on the year over year growth, you're like, okay, last January I made this much. This January I made this much. That's a 800% increase. And you're just like, oh, that's why, like, that's crazy. And that's not sustainable. But what happens is as that percentage starts to come down, your income starts to go up. So you're not going to go from 800% to next year. Also, more than likely, probably not going to go to 800% next year, but you might go from $10 in 22 to $80. I think that's how that math works in 23. Now you might only be at $120, which is not 800%, but now you're at $120 for January. And you're like, that pays my cell phone bill or my cable bill or whatever it pays. So that's one of the tips I can give you is tracking, finding some way. There's plenty of websites and apps and all kinds of stuff. And like I said, I can send you my spreadsheet. And it's just very important to track that stuff just so you can have something to focus on, because there's going to be ups and downs in the market, or it's not going as fast as you think it is, or whatever it might be. And then when you can actually put your numbers in and actually see the growth, you're like, okay, I'm on the right path. And that should help your motivation as well.
Sure.
But okay, so next one. If you end up getting to the point where you can retire, and let's just say you can retire early, and your dividends cover your income, but because of the dividends snowball and compounding, where, this year you might make, $100,000, next year you might make $110,000, and then it'll go up to $125,000 and so on. When would you, if you had to forecast this, when would you think like enough is enough? Is it like when you can replace your paycheck dollar for dollar? Do you want more than that? Or are you going to have a hard time like I am of actually stepping away and be like, okay, like $150,000 is plenty. It's like triple what I need. Like it's plenty enough. Like, what do you think about that?
Yeah. So, I mean, I watched the video with Chad last night. And so I was kind of thinking about it a little bit. And because at some point, it almost becomes kind of self-sustaining as far as like if you're dripping your dividends back into additional shares. So I was kind of thinking, I mean, at the point where you're equaling your income, that's nice. But if you wait a couple of years to where you're 1.5ing or 2xing your
Mm-hmm.
income, then in theory, at that point, that additional, you know, years worth of income then itself kind of becomes almost like self-sustained, where you could take out the 1 year's worth of income to actually live off of. Then you have that second year's worth of income that can then just be dripping back into growing,
Yep, exactly.
even further. And then potentially you could have, a situation with like generational wealth,
Yep.
where you could then pass down, you know, whatever's left or whatever you have, kind of when you cease to exist, but potentially your family could go on with, whatever you had. Um, so at some point, again, it almost becomes like kind of a self-sustaining thing where you can take out your income, but then you essentially have a second income that then continues to grow beyond just the amount that you're living off of.
Exactly. And well, that's cool. What's dividends too is
Depending on
because
kind of how quickly that happens, I guess.
yeah, yeah. Well, and so with regular investing, especially companies that don't pay dividends, like they always say, don't kill the goose that laid the golden egg. And that's really the principle. I know many people have heard of the 4% rule, which is basically as long as you withdraw 4% of your portfolio, you should never lose your initial balance.
Mhm.
So therefore, you're just basically living off of the interest. With dividends, whether it's the yield or capital appreciation or both, the total return, you can often, especially if you compound for years and years and years, leading into decades and decades, to your point, if you get double your income, not only was that sustaining that your current lifestyle, and you're also leaving a wiggle room in there to increase or decrease your current lifestyle based on, maybe by then you don't have a mortgage anymore on the condo, and the condo is paid off and all your debt's gone. So your income stayed the same or actually increased while your expenses is also decreased. So maybe you need less, and you have the option to, go out on a vacation or do whatever. But if none of those things happen and everything stays the same, you're making so much more money than you need that you're still not only living off of this portfolio, but you're able to keep it growing at a significant rate as well. Now, it's not as quick as if you didn't need any of the money and you could just, put that whole $150,000 into the portfolio. Maybe you're only putting 75,000, but that's still money that gets you money. And, there's the snowball. So, I mean, it sounds like you have a little bit more of a logical response than I do, because I know I'm just greedy and competitive. So like to me, if I can make $60,000 year 22 and live off of that, but then I wait one more year and make an extra $12,000, like why wouldn't I do that? And then if I wait one more year and make an extra $14,000, why wouldn't I do that? So
Yeah.
it's one of those things where it's like, I mean, it depends on your job and your situation, and like if you are healthy enough to keep working, or if you have something else that you want to do or whatever. So, like I said, I've said this in every interview I've done so far. I know that's going to be a problem for me. Maybe it won't. Maybe I'll just be ready to go, and as soon as I get enough and it's 1-to-1, I'm done. But I know that's 22 years from now, so we got some time to think about it. Okay, so next one. So I know you just started recently, but I would say, what is your biggest dividend mistake, and what did you learn from that mistake?
Well, I mean, like I always said, kind of the same mistake of everyone starting out, kind of, chasing yield more than stability, I guess. So, I mean, yeah, again, I kind of got into a couple of tickers like USOI, SJT, that had pretty high yields at the time. Um, I think SJT treated me a little bit better than USOI did, because USOI was just basically burning capital, which I kind of didn't realize until, you know, whatever it was, 6 months later, and it's down, $500 or something.
Yeah.
At which point I was like, okay, well, yeah, that's just not coming back. And haven't, made that $500 in dividends or whatever. And so I was just like, yeah, it was just not doing anything for me. So pretty much just I think I left like one share just to see, just so it was in the portfolio, just see what
Now,
dull it was, what it was doing.
question
But
on
basically,
that. With these, because I spoke to my cousin about this, because I used to also watch Let's Talk Money with Joseph Hogan. He has his CFA and stuff behind there. Often, I mean, he put that behind there for a reason. The CFA, like he wants him to seem reputable. I obviously don't have any degree or anything with it, but I post my monthly results and let everybody see what I'm doing. Um, did any of the stocks that you bought that were really bad performance, did they come from these channels, or did you find them by a certain way, or how did that work?
No, I think that originally when I got started, I mean, that was a year ago, so I don't remember exactly, but I think I originally started with like an account on the app Public, I think.
Hmm.
And it had some like, just kind of basic search tools where you could see like, yield and some other things. And so I was just, looking for things with good yield. I don't think that any of those particularly came out of, like specific like financial advice channels.
Okay. Yeah. Cause I mean, that was
Pretty
one of
sure they probably
my,
would recommend this anyway.
yeah,
But
I mean, I was the same way as you, looking through the comments and watching the videos and all kinds of stuff. And there's one stock I still hold that I got from a channel, which, seems to meet everything, was APD. Um, or yeah, APD, not ADP, APD, which is the Air Products and Chemicals. I bought that from a YouTube channel, but it was convincing. And I mean, everything seemed to be on the up and up. So I bought that. It's not one of my favorites. And that's the other thing too, is like, even though I have a YouTube channel and I make these recommendations, that's why I always say do research and convict, like have your own convictions about the stocks that I mentioned. My goal is just to present you guys with options and things to look into. But if you end up just like, oh, Troy mentioned this on this Friday's video, I'm going to just go buy it. If it goes down, you don't have the same conviction. You're more likely to sell because you didn't convince yourself that this was a stock for you. So if it goes down, then you just, get really emotional. I shouldn't have listened to that guy or whatever. Do your own research and stuff like that. So all that to say what I was saying about Joseph Hogan, any other people like the Dividend Bull or whatever the other people are, I've seen a lot of their stocks. Like I quickly just screen them. Like I went through, I had one of Joseph's videos come up in my feed not too long ago, looked them up, and literally every stock was not only underperforming the market, but over the last 10 years, but some of them actually lost money over the last 10 years. And I'm just like, why are we, I know the reason I get upset about that stuff is because I know there's other people that don't have criteria. So they just watch these people and they just buy them. And I'm like, guys, like us as content creators need to do better of like having at least some standards that we set for the stuff that we present to you guys. And then also the people that are watching the videos need to understand that having a criteria is vital to your success and everything else. So
yeah, so I do kind of a similar thing, I think, to what you were just saying now. So when I'm watching, some of the different channels and they're like, this ticker, that ticker, I'll just literally just like open a new tab while the video is playing, type in the ticker, and just look at like the 10-year, total return on whatever it is, SDIV, which is lost like 70% of its value in the last
yeah. Yeah,
5 years.
exactly. That's good. The order of the criteria, like I'd always probably pick the strictest or the one that matters to you most first, just because you're like, okay, I don't want to waste more time than I need to on this stock. If your big one is like, I need stocks that outperform the market, because that's the same thing I do. Then if you do that one first, it's a quick research. You're like, okay, no. And then you don't need to waste any more time on it. You're like, thanks for the suggestion. Not for me. It might be for somebody else because they're at a different point in their journey, but it doesn't need to be for everybody. So that's really
Exactly.
cool.
So,
And
the other thing that I'll tend to do is, again, seeking alpha. I'll like go to the ticker and then I'll click on the charting link, and so I'll just compare that to SPY and QQQ. And if the line's like way under SPY, I'm just like,
yeah. And that's a real cool, real quick, real cool check of just be like, okay, like I'm not going to waste more than 4 seconds worth of research on this one. Like if maybe it passes that one and maybe you have another criteria or 2 more criteria and it meets all of those. It doesn't just mean click the buy button right now because it met those 3 criteria. Like maybe you have, here's my 3 pillar criteria. And then here's like 2 other things that I'd be interested. Maybe it's a tech stock and you already have too many companies in the tech sector. And you're like, okay, it met all my criteria, but I'm already overweight in this sector. Let me put it on a watch list. I know it's quality, but it's not right for me right now. So that's again, another, like you can have, like I said, your pillars. Yeah. I don't really have a watch list. I look at so many stocks. I just start to remember which stocks I've seen them from research on my own stuff or research for the videos. I've seen them and I'm like, okay, I know this one outperforms. I know it met XYZ. If I ever get to the point where I'm ready to buy other stocks, like right now I have 11. If I want to add more, I'll add more. But like, I like having a smaller portfolio. That way I can at least build the positions because I don't have, tons of money going in these things. So, I mean, if you get 100 positions and you only have $100, what do you got, $1 in each one? Like you're not really going to make any progress. So I'd rather have 10 positions and have $10 in each one. But anywho, I digress.
And I'm kind of starting to get to a similar point where I've seen enough of the tickers so many times and a few of the different lists that I have kind of different criteria where it's like okay, yeah, I recognize that ticker, and there's kind of a short list of like these are some of the pretty super outperformers over those 5, 10 years or whatever, versus whatever it is QQQ or SPY.
And I like those that thing that Seeking Alpha has where you can just like create portfolios for free, like not necessarily things that you've bought, but like just a list of stocks that you want. Like that's how I start my research with the X Dividend, like the Power 5 videos. I just put them all in there and then I export because you can export information for free as well, which is really, really cool. So you can like, it'll bring up everything, momentum, performance, debt, like all kinds of stuff. And you can just export a spreadsheet and then you have it, which is super, super cool. So
I've exported a few portfolios and done a little bit of Excel kind of analysis on some of them, just looking for different.
And then I have the video that I have on like how to filter for dividend stocks that builds off of my criteria video that I made, and I literally walk people through how I would find a stock that met my criteria by doing those formulas and filtering and exporting from Seeking Alpha and all kinds of stuff like that. So really helpful videos. And like I had someone from the dividend group yesterday actually comment on it, and he's like, hey, like he doesn't look for the same stuff I do, which is fine. It's not right or wrong, but he was able to use one of the formulas that I used in that video to help him with his research. And that's good. Like that's all I care about. As long as my videos can help you find your next stock to make you rich or get you into dividend investing or even teach you a formula in Excel that you didn't know, like that's my goal here. So, okay. So do you have, again, you're new, but do you have any biggest selling regrets or a biggest buying brag? Like something that you identified and it's skyrocketed since then, or something that you weren't convicted in, you sold it and you're like, man, now it's up a lot. I really shouldn't have done
that. Sort of not. It's kind of a, I'll just say like SJT, San Juan Basin Trust, it was on a couple lists because during the pandemic, it was pretty much just skyrocketing due to whatever production issues during the pandemic, and so the prices of oil and natural gas were going up, and so the price of the stock itself and its dividends were both going up, and so pretty early on I bought into SJT, like whatever it was, 100 shares at whatever the price was, and it went up pretty significantly, and so I ended up this was fairly early on, but I took like maybe a $500 or $700 gain. Basically sold pretty much all of it and then kind of diversified it out into different, probably somewhat better picks long term. And then I did end up buying back into it, and made a little bit more money out of it, but then ended up losing some of it again as the price went back down. I didn't get out of it quite as soon as I should have.
So I mean, that one's kind of sounds like both. That sounds like both scenarios.
Like, it's a little bit of both.
Yeah, that's
it was going up, and it kept going up, for about a year or two, and so I made pretty decent amount of money on not too much invested. I mean, I could put in like 1,100 and pulled out like 16 or something like that. Yeah. And I ended up buying another 1,100, and then it went down to like 9 or something.
Yeah, my most recent example of it was Nvidia. So I had Nvidia. I bought it when it was I bought it because of the dividend group. That was the last stock I've done that with. And it went down a lot. I seemed to bought it at the all-time high, and then it went down a lot. I just kept dollar cost averaging because that's what I believe in. So I just dollar cost averaged. I got my cost basis below $200. Then it was on a rocket ship this year, and I was like, okay, like it doesn't meet my 5-year dividend streak, and it doesn't meet my dividend growth rate. Like it obviously outperforms the market, but it didn't meet my other two. I was like, okay, I'm up 55, 57, whatever it was % on it. I was like, let me just go out. Literally like 2 days later, it goes up 25% after earnings. And I was like, of course, like I now where I would have been bad to compound my mistake by buying in now. Cause like now it's, peak of all the rage and all kinds of stuff. Like it still doesn't meet my thing. So that would be the FOMO. And that's the idea of having a plan. Like, okay, cool. I missed out on this. At the end of the day, I still made my 55, 57%. I put that in a new company. Like it's all kinds of stuff. So it's really the full spectrum, and yours is even more so with the, like you bought it really low. That was a good identifier by you. It went up, you took your gains, then you bought back in, and then it went down. So you got to experience the gains and the losses of the same company.
A little bit of both.
Yeah, that's pretty cool. Okay. So as long as your gains outweigh your losses in the long haul, I guess it's okay.
I think it's about washed.
Yeah. Okay. So the next one, this is a new question just for you. Has dividend investing given you any good habits or bad habits since you've been doing it? Like, has it created any habits for you that you're like, man, like, this taught me a lesson that I can use for life? Or has it created anything bad where you're like, man, because I'm doing dividend investing now, I'm, whatever.
Uh, that's kind of a hard one. um, I mean, a little bit of both, sort of a maybe double-edged sword. I mean, since I've gotten into dividend investing and seeing, I guess kind of monthly income going up, and obviously that makes me want to invest more, which is a good thing. But on the other hand, I also have, a bit of debt that I'm trying to get out of. So you have to kind of balance between, well, do I want to put money into, you know, growing my income a little bit, or do I want to put that money towards getting out from under the debt, or kind of do like 50-50 thing or whatever. So I'm not quite sure kind of which way to go. I do like the idea of growing the income, but whether or not I'm growing it fast enough to make a difference right now versus just getting out of the debt and then putting that money then towards investing. But there's enough debt where it would probably take a good, year or so to get like totally out from under it. So it's like,
Yeah.
Which one do you do, and are you kind of shooting yourself in the foot by putting the money towards the investment versus getting out from under the debt? But I do, more or less a plan to get out from under the debt.
Yeah.
Between cashing on vacation time and then using money to just take a big old chunk off of it.
Yeah. Well, and I think Chad actually talked about that in his interview, and I like his idea of basically don't ever stop investing. Like, always put something in there, even if it's small. So like, pretend you put $1,000 a month into your investing account. Maybe a 90-10 rule where you take 10% of that $1,000 into your investing account just to keep the constant. You don't lose that good habit that you created of putting money back and saving for yourself. But also you can put 90% of that on your debt, because at the end of the day, like we talked about earlier, if you can get that debt down to zero, the minimums and any stress and all kinds of stuff that comes with that debt being there, all that money that you were using to pay off your debt now supercharges your investing. So you don't want to miss on, the years of compounding by not investing at all and going 100% into debt in your situation. But if you can do 10% into your stocks to keep that portfolio going and slowly increasing, you're not necessarily missing out on that compounding, because you're still going to get your compounding just with smaller amounts. And then you can also, like I said, hypercharge the debt payoff, get that done, and then you can almost make up for lost time, because then your expenses will be way reduced, and you can probably even increase your $1,000 a month that you're putting in your account to maybe $1,500 a month, because now you don't have any debt. You don't have to worry about minimum payments. And another thing to think about is a cool way to think about this is when you have debt, the interest rate is your rate of return. So not only are you reducing your expenses, but if you have like a credit card debt where credit card interest rate, I think the average is like 20%. So if you can get a credit card paid off and you're paying, the minimum payment plus some to get that gone, you're saving yourself 20%. Basically, your money's getting you a 20% return, which, I mean, in 2020, 2021, we were able to get that. But like, I don't know if we're getting that in 23 or 24 or 25. So you're almost guaranteeing yourself whatever your interest rate is as your rate of return while you're paying off that debt.
About like 7%, just because I have a
Yeah.
good deal from an old special offer. That was basically like a some particular credit card for like a one of my old university like honor societies had like a special offer where it was like 7% or whatever instead of like.
Is it 7% forever, or is that like an introductory period?
Basically, yeah. I mean, it was basically, it was a special thing specifically for like the honor society members or whatever. It was like pretty much 7% for life.
Yeah. And
so far they haven't raised it really.
Yeah, I mean that's really a good rate, but like, I mean that's a guaranteed 7%. And you can also pay that off, and the money that you're putting on that card every month to at least cover the minimum payment to not kill your credit score, that plus the 7% return then goes to your investments, in a year or 2 years when you pay it off, and then you're hypercharging the investments, and then you can make up for that lost time. So that's just my point of view on it. I've been fortunate enough with good luck and good, like, I've always been a saver and pretty frugal. that I got the car paid off. I refinanced the house during COVID, like all kinds of stuff. So my interest rate's really low and I really only pay, monthly bills and the mortgage. So that's pretty much it. So
it's taken me a while to get to that point, but I'm kind of the point where I'm like, yeah, let's just get debts paid off
yeah,
and
yeah,
just get it to where hopefully it's then just income for the
yeah.
most part.
Well, and at the end of the day, there's not necessarily a wrong answer. It's just like the opportunity cost, right? Like, so it's like, okay, do I do this? And there's probably calculators or something that you can do that, like, here's how much debt I have, here's how much I can put towards it, here's how long it'll take me to pay it off versus putting that same amount in the whatever. So you can probably find something like that. I haven't seen any of it, but I'm sure it exists. Maybe ChatGPT knows. I don't know. You can ask them. But okay, so that's the habits question. So, okay, here's the next thing. This is going to be fun. If you could invest in one dividend stock, you can't cheat like Chad did. It can't be an ETF. One dividend stock for the rest of your life. What is it and why?
Yeah, that's always a tough one. It's hard to say. If it were an ETF, probably QQQ, just because it has pretty much the best overall portfolio return. Pretty much all the like broad market index funds. As far as like single stocks, honestly, I'm kind of a fan of ABR, just because over the last 10 years it's had phenomenal returns. As far as decent price appreciation. It's gone up and down a bit, but it's literally like pretty much every quarter or every other quarter raises dividend by like a penny, which doesn't sound like much, but when you're reinvesting in additional shares, and then on top of that you're getting a dividend increase pretty much every quarter, then those increases tend to snowball fairly quickly. And at the end of the whatever 10 years, I mean, I think I put it in the back test calculator, and if you bought like 100 grand worth in 2010, it ended up being like 1.4 million at the end, and then the income was like 180,000 a year or something like that.
Yeah, that'd be pretty. Hey, that's pretty
crazy.
Nice. Yeah, that's pretty, and that's all without touching that 1.4 million in there. So,
right.
I'm trying to look right here and see if ABR is a. Yeah, so ABR. So here's the thing to always think about with this kind of stuff too. I actually thought about this. So their dividend growth rates are kind of wild. I don't really know how to read
it is a REIT. So
yeah, exactly. So it's qualified, which means all the income received from the dividend is just taxed as regular income. Which, if you're able to only like, pretend you don't have a taxable brokerage account and you're only able to invest in it in your 401k or an HSA or a Roth IRA, like it would be tax sheltered. So it's kind of a no harm no foul kind of thing. But if you had this in a taxable account, that would be something to consider for not necessarily you, but anybody watching that's like, oh man, ABR that meets all my criteria. It is if you make $100,000 a year and then you're making $100,000 a year off of ABR, you're technically making $200,000 a year. And you will be taxed accordingly because the government wants their money. So that's something, but that's a really cool pick. Like I said, I'm not,
but it's a good problem to have if you're having,
yeah, exactly. Yeah. Oh, I'm making so much money. Yeah, exactly. So, I always like to keep as much of my money as I possibly can. So, just try to figure that out. But okay. So that's that one. Let me ask you this final question and then I'll let you have the rest of your, whatever day it is, Saturday, back for yourself. Do you being a new investor yourself, do you have any advice for newer people that are just getting started in their dividend journey? And if it's the obligatory just get started, what else do you got?
Well, I mean, I feel like I'm new enough that I don't know that I necessarily have any particularly great advice, just because I haven't been doing it long enough to know.
Have you had like an aha moment that you can share for maybe a new investor that they, might not have reached yet?
Well, I mean, the usual, kind of don't chase yield if it's gonna, chop off your left hand and put it in your right or whatever.
Yeah.
I mean, yeah, that's probably one of the big ones, I guess, is that a lot of the high yielding securities just tend to lose capital over time. And so you're not really getting ahead. Now, sometimes if you're like dripping the dividends back into more shares, you can still come out slightly ahead. So you're not, total net negative, but the opportunity cost of, not buying something that just strictly performs better. If you're only getting like 5% over like 10 years, as opposed to 150% if you're buying whatever, like ABR or Microsoft or something else.
Yeah.
Then I mean, it's really just
Yeah.
not worth it
It
because you're just not getting anything out of it.
Yeah, it's really the opportunity cost at the end of the day. Like if you put a dollar into this one versus a dollar versus that one, like over time, which one would have been better for you? That's the opportunity cost. And then also what you were saying about dripping, that's almost like using like a cup or a sponge to save a sinking ship. Like you're just like, okay, like I can add a little bit money to this and it'll stop it from sinking as fast. You're like, if I just scoop this water out and pour it over there, it'll, it won't go down as fast. But like at the end of the day, if you're losing capital year over year, hand over hand, fist over fist, whatever phrase you want to use, you putting the money back into a sinking ship isn't really gonna, stop it from going down in the long haul anyway.
Right.
So
So yeah, so lately my focus is more on looking for those stocks that have long-term history of growing their dividend consistently. In some cases, looking for the ones that maybe grow it every single quarter. There's like the ABRs, AMTs, CCLI, PAG, which is the Penske Auto Group, a few other ones that just very consistently grow their dividends and also have some capital appreciation coming too. And I've just been looking at things that tend to kind of outperform the market historically in the hopes, obviously past performance doesn't predict future performance, but, if something's consistently, over the last 5, 10, 20 years, whatever, consistently been above, SPY or QQQ, then if you were to put together a portfolio of those things, then maybe you end up, getting a much better return on your money versus the things that have a consistent history of just going down the toilet.
yeah.
Your SDIBs or other things where it's just straight lying down.
Yeah, exactly. Yeah, you up and to the right's where we're always trying to go for.
Yeah.
It's and the other thing that you mentioned about like past performance doesn't, indicate or guarantee future success. I hear that a lot because like I said, that's one of my three. I really have like three core and then maybe one or two, secondary pillars to my criteria. That is true. However, I could argue that I would rather invest in a company that has a reputation of showing that they know how to outperform the market and do it over a long period of time versus putting my eggs in the proverbial basket of a company that like, oh, they've promised in the next 10 years to beat the market, but they haven't shown any ability to do so in the past. So it's one of those.
Like I'd rather have a stock that goes straight up than one that goes
Yeah,
straight
exactly.
down.
Yeah. Or like even the ones I always pick on this stock, but like AT&T, like they've been like almost a straight line for like the last straight line or like slightly down ticking line for the last good while. They've always had a nice yield and all the things. And then they're like, oh, we're going to do this merger and this spinoff and this stock split and all kinds of stuff, anything they can do to jumpstart it. But at the end of the day, like, I mean, I get it if you're an income investor and like you end up needing the 7% or whatever yield that AT&T offers. But again, it's the opportunity cost of like you're only getting the 7% yield because you're either going to lose money in capital, at that point it's the capital depreciation, or you're going to end up being stable. So it's only the 7% versus if you have a company that goes up 10% in capital every year and also has a 3% yield. Then you're getting 13, and it doesn't really work like this, but then in theory, you're getting a 13% gain versus the only 7% from the yield because you're only looking at the surface level. So those are all just really important things to remember, and I completely agree with you. So all right, well, do you have any closing remarks, anything to say to the people for your moment of fame?
I mean, nothing terribly specific. I mean, I've been toying with some other ideas as far as kind of strategies or that sort of thing. So, like one of the things that I think I'd mentioned in the comment on Chad's video was kind of the idea of like a dividend round robin, um, which kind of my idea was that if you get like a portfolio of a few stocks that kind of pay at different kind of points in like the quarterly cycle or whatever, then it might be possible to take like the dividends from one stock and then essentially look for the next stock that has an ex-dividend date that's, I think, what I say, at least like maybe 3 to 4 days after you get your payment, so that you could buy additional shares and they settle before the ex-dividend date, and so those additional shares give you additional dividends from that next stock, which then can be invested into whatever the next stock that's about to go next dividend would be. I haven't run any actual numbers on it to know whether it would perform any better than just dripping from the same ticker back into itself, and then just getting those additional returns, whenever the next quarterly dividend payment is.
Yeah, that was a really cool strategy. Like I don't know the easiest.
Compound more quickly? Does it grow faster? Or
yeah.
not?
I do think so. A couple things on that. One, I think it's a really cool idea. I don't know the quickest way to like figure that out. Like if it works, like I feel like it's just it would be very time consuming. I know I know how to do it the time consuming way. I'm hoping that there's a shorter way.
Very, very actively managed.
Yeah, exactly. Well, it's actively managed, then it's also actively researched to try to figure out if it's even worth actively managing it. So it's like a double whammy where you're like, okay, I'm going to spend hours worth of research for this thing that might work. And if it doesn't work, then I just wasted that time. And if it does work, does it work enough that it was worth?
If you find out that it didn't work, I don't think it's wasted time because it didn't.
Yeah, I mean, it's like Mythbusters. Yeah. So on that comment, the one thing I do want to say is I don't know how long you've been subscribed, but if you haven't seen, so I have two playlists that I made that reach into the first part of your question that the idea that you were bouncing around. I created two portfolios. One is yield focused. At the time of recording, it was 5% yield. And then one is more dividend growth focused, which is the one that's the one I have the wife on. And that one I think had like a 14% 5-year dividend growth rate. So really, really good. Of course, both portfolios are outperforming the market in combination, but it's exactly what you were describing in the comment. It's 12 stocks. Each of them you're going to be missing 4 weeks because there's 52 weeks and each of them are quarterly payers. So you're only getting 48 paychecks. But when you end up looking at a calendar, every week you're getting paid something. So you can check both of those out. Like I said,
the initial idea behind the portfolio.
Yeah.
Pretty much just that.
Yeah. It's super cool. Like I said, I have the wife on it. My stepdad's on the higher yield one because he's closer to needing the money. And I followed up with him and I see the wife's portfolio. So I know how I actually get her alerts on my phone. It says so-and-so, 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 like dividends all the time, which it's kind of funny to think of it like that. You're just like, oh, this company paid me money. Oh, this next company paid me money. So
it's too much money.
Yeah. What do I do? I didn't use the last money yet. So it's one of those things, but yeah, definitely. If you haven't seen those, check them out. It's the part of the Getting Paid Weekly series that I did. It's just 2 videos. Like I said, the high yield one. Yeah, it might not be one that you're interested in because it is high. Like I said, it's 5%. The other one, the 14% growth rate one is actually at the time of recording, it was in line or slightly above or below the yield of the S&P 500. So not only is it crushing the S&P 500 in growth rate, it's outperforming the S&P 500 in capital appreciation, and it's still giving you the same yield. So that I was really proud of that one. I wasn't expecting the yield to be as high as it was. But yeah, just 12 stocks. You buy them all, the combination of all of them, you'll get something from somebody every week. And that might be your starting point. If you did want to dive in and do that research, that might be your starting point where you can dive in and be like, okay, let's start with these 12 stocks.
Well, originally that was my starting point, was just kind of the idea of like a weekly, quarterlies portfolio, basically just 12 stocks that each fall in like 1 week of the quarter.
Yep.
And then just kind of put money into each of them fairly evenly, and then just over time, you get a couple cents a week, and then a couple dollars a week, and then maybe $10 a week.
Yep.
And maybe a couple tens of dollars a week.
Yeah.
And over time, that kind of snowballs.
The hard part on the research was there's stocks that pay the first week of January, but then they don't pay till the second week of April. And like, it was too hard to find like, okay, this one paid the first week of January, that one paid the second week of January, and then they flip-flopped in April. So like I had to draw hard lines in the sand and be like, okay, like you always have to pay between 1 and 7 of every month that you pay in. And you can't pay like January, April, and then you're supposed to pay in whatever that would be July, but you pay it early and you pay in June. So those stocks got excluded and stuff like that. So there was some really good names that I had to exclude on there, but like it was I had to make it that way. And then there's also the other thing, just for extra complication, because I'd done all this research. There are certain stocks where the ex-dividend date is up to like 6 weeks before it pays. And then there's other stocks like Apple, for whatever reason, the largest company in the world, I believe, they pay out like 9 days after their ex-dividend date, which it seems like it would be like, oh, smaller companies, they got less people, less volume, all the things, they can pay out quicker. Whereas the big companies might need more time to gather all their shareholders and volumes and stuff like that. But yeah, for whatever reason, Apple's a super quick turnaround. So you could buy Apple, get paid really quick from Apple, but then the next stock that might pay, the ex-dividend date might have already passed and you already missed that boat. So it's probably not as quick of a compounding as you think, but it's still, either way, quicker than quarterly, which is to your point.
And I started running some numbers, or at least trying to, just with a just kind of a sample set of tickers. And actually, one of the kind of weird things that I ended up seeing, at least in just kind of a small sample of like a year or so of dividends, was that certain tickers would end up taking most of the new dividend money just because of how the ex-dividend and payout dates kind of lined up or didn't line up. Because some of them would be, you'd have the ex-dividend date and then it would be payout within 5 days. Or some of them would be like 2 weeks.
Yeah.
And so then, just kind of based on when things paid out versus the ex-dividend dates, it was like certain tickers would just end up soaking up like all of the money from like the previous, whatever, 3 tickers or something.
Yeah. What do you do if you have 2 of them that go ex-dividend the same day? Like, do you split it or whatever? And like,
or do you just take the one that pays out first?
Yeah, well, yeah, the one that, so like pretend June 1st. June 1st pays out first, or June 1st is your payout. You have 2 companies that both go ex-dividend on June 8th, let's just say. Okay, how do you pick which one? Like, okay, the one that pays out on, that goes ex-dividend June 8th, one of them goes payout on June 15th and the other one goes payout on June 21st. You put it in the one that pays out sooner, knowing that even though it pays out sooner, you still can't put that money on the other one that was June 8th because that ex-dividend date's already passed. So you have to skip it. So, I mean, I'm really
just put in whichever, next, ex-dividend date.
Yeah.
Hasn't passed.
And then you'll have to try to remember like next year or next quarter, I guess, when they go ex-dividend, if they both go ex-dividend the same date again, that you would be like, okay, last time I put it in this one, or maybe do you keep doing that one and maybe you just put new capital in the other one that the one you're neglecting.
That was one of the things where I was noticing that it was kind of always going to like the same ticker and certain ones were getting skipped. But I was thinking, well, you'd also be still investing additional capital into your Roth IRAs. Maybe you just put that into ones that got skipped to just kind of raise those ones up.
I feel like you would have to use the new capital almost to keep it balanced.
Be very, very actively.
Yeah.
So maybe it wouldn't be worth the time and just dripping stuff back in.
Yeah, it'd be fun. Yeah, like I said, if you want to check out either of those videos I made, like I said, the 5% still not like dangerous. Like it's not a dangerous yield. Now some of those actually on an individual level actually did underperform the market because it was just impossible for me to find 12 stocks with higher yields that also outperform the market that paid on certain days. But in total, the whole portfolio over the last 10 years has outperformed. And then the other one, the dividend growth rate one, every single one of those individually and as a whole outperformed the market. So that one killed the market. So that was just really, really cool to see. And I've seen people do that, and I wanted to do that when I first got started with the whole, how can I make, like, it, because pretend you only have, 5 stocks, a handful of stocks, and they all pay in, the most common quarters are March, June, September, and December. Then you're like, okay, like not only am I just getting started, I'm only making 20, 30 cents, $1, $2, whatever, but I have to wait to get it quarterly, which is the same 3, 6, 9, 12 that it is every year. You're like, that doesn't really keep me motivated. And I've seen so many posts and so many people like, okay, this one pays here. I need payers for, February and those months or whatever. They just pick any random stock. So I was like, all right, let me do a favor to everybody and let me find stocks that will do what you're trying to do, but they're also not going to lose you money in the long run too.
Yeah, that was kind of my thinking too, was, because a lot of people will say, well, you shouldn't buy something just based on what pays
exactly.
Out. And that's should be kind of obvious. I mean, just the data itself doesn't really tell you anything about how well the stock does.
Yeah.
But if you have a good, like I have some fairly large watch lists that have pretty good performers, whether it's high dividend growth rate or high capital growth rate, and so if you have fairly large portfolio of all of those, you have maybe 20, 30, 50 different tickers, then it's easier to pick from those well performing things. Basically, just kind of sort it by month. then by like week of the month, then you just have like 5 or 6 different things that are all in this one particular week.
Mhm.
You say, well, this one's kind of the best performing. You just kind of pick that one.
Thank you all for watching today's interview. If you guys wouldn't mind leaving a like on the video, and make sure you guys share this with anybody else that you know that's into dividend investing. Also, don't forget to subscribe and ring the bell so you guys can stay up with all of my other dividend related content and other interviews. Lastly, if you'd like a chance to be on an episode of Dividend Discussion, make sure you guys send me an email at dividendobsession@gmail.com and I'll be in touch. But until next time, see ya.